Welcome to the SafeSimpleSound podcast, where our constitutional approach to financial planning creates both and solutions for the contradictions families face. I'm speaking with you today, drawing from our team's chartered financial consultant background and our deep development of the S3 framework. Today, we are arriving at the destination of a journey we've been on for the last few episodes. If you've been listening along, you know we have been dismantling the complex world of risk transfer, what most people call insurance, and rebuilding it through a constitutional lens. In part one, we looked at the math, the foundational requisites of what makes a risk insurable. In part two, we examined the money, the economics of affordability and feasibility. But today, in this final chapter of our series, we are turning our attention to the most variable, unpredictable, and powerful factor of all: you. We are exploring the concept of adverse selection and the human element within the insurance system. We recently wrote about this in our blog series, specifically because we've observed a pattern in our practice. Families often view insurance as a static product they buy off a shelf, like a box of cereal. But through our SafeSimpleSound methodology, we know that insurance is actually a dynamic relationship between you and a risk pool. The challenge we are exploring today is the tension between your desire for privacy, the freedom to act as you please without scrutiny, and your desire for trust, which allows you to access the best rates and protections. Is this an either-or dilemma? Must you choose between privacy and protection? From our team's perspective, the answer is no. This episode will give you the tools to understand your role as what we call a risk architect. Whether you are a business owner, a head of household, or someone approaching retirement, understanding this concept will help you align your behavior with the system, creating a synthesis where you lower your costs, increase your stability, and solidify your financial constitution. Let's step into the human side of the equation. To begin, let's establish the foundational challenge using our SafeSimpleSound framework. In the world of risk management, there is a concept known as adverse selection. Now, that sounds like a dry economic term, so let's make it simple. Adverse selection is simply the tendency for those who have the highest probability of having a loss, the people most likely to need a payout, to be the ones who most aggressively seek insurance. Imagine a buffet where the price is set based on the average person's appetite. If the only people who show up to eat are professional competitive eaters, the restaurant goes broke, or they have to raise the price to $50 a plate. That is adverse selection. In the insurance world, if only people with serious illnesses bought health insurance, or if only people with terrified knowledge of their home's bad wiring bought fire insurance, the risk pool would drain immediately. Premiums would explode and the system would collapse. This creates that tension we mentioned earlier. This is the safe component of our discussion today. We want to validate a very common feeling. It is natural to want to hide your risks. When you are applying for coverage, there is a fear that if you tell the whole truth about your health history or the age of your roof or the nature of your business operations, you will be punished. You worry you'll be denied or priced out. So the instinct is to withhold, to keep things private. However, drawing from our CFC background at SafeSimpleSound, our approach suggests that this instinct, while understandable, actually works against your constitutional stability. This brings us to the principle of soundness. Insurers are constantly on guard against adverse selection. They use a process called underwriting. Now, many people view underwriting as an interrogation. They feel like the underwriter is the enemy, looking for a reason to say no. But through our S3 practice, we encourage you to reframe this. Underwriting is not punitive. It is the safe mechanism to categorize risk fairly. It is the gatekeeper that ensures the pool remains healthy for everyone, including you. When a participant in the system hides information or fails to maintain their property, they are signaling to the system that they are a high risk. They become the adverse selection that the system fears. Conversely, when you demonstrate transparency, when you show that you maintain your assets, you signal preferred risk. This is where we find the stakeholder synthesis, the both-and solution. You don't have to choose between being exposed and being protected. By becoming a risk architect, you align your interests with the insurer's interests. Think about it this way. The insurer wants a stable client who won't have a catastrophic claim due to negligence. You want a stable financial plan that won't be derailed by an uninsured loss. You both want the same thing: stability. There is also a legal dimension to this soundness. Public policy dictates that we cannot insure everything. For example, you cannot buy insurance against getting a speeding ticket, and you cannot insure an illegal business operation. Why? Because it would encourage reckless or illegal behavior. This reinforces the S3 principle. A financial plan built on hiding risks or trying to ensure unethical behavior is a house of cards. It lacks soundness. True security comes from aligning your risks with the law and the societal good. So, how do we move from being a passive buyer who fears the underwriter to an active partner who utilizes the system? It requires a shift in identity. Our framework demonstrates that the most effective approach is to view yourself not as a customer buying a product, but as a partner presenting a profile. You are marketing yourself to the risk pool. By applying simple maintenance habits, by documenting your safety systems, and by choosing appropriate deductibles, you are effectively telling the story of your risk. When you retain small risks, meaning you pay for the small stuff yourself through a deductible, you prove you aren't trigger-happy with claims. When you act honestly, avoiding concealment, you prove you are a partner. This is the foundation. But what does this look like in the real world? How does a family actually navigate this transition from adverse selection to risk architecture? To illustrate this constitutional principle of the risk architect versus adverse selection, let me share a hypothetical scenario that illustrates how this plays out in practice. While this story is created for educational purposes, it demonstrates patterns we see when families apply S3 thinking to their risk management and the pitfalls that occur when they don't. Picture two neighbors living in identical historic homes in a fictional town we'll call Stability Springs. Let's call them Arthur and Brenda. Both of their homes are charming, but they are older. They both have roofs that are nearing the 20-year mark, and they both have electrical panels that were state-of-the-art swear through Fortitude in 1980. First, let's look at Arthur. Arthur operates from a place of fear and scarcity. He views insurance as a tax he has to pay, and the insurance company as an adversary. Arthur knows his roof leaked a little bit last winter during a heavy storm. He patched it himself with some tar he bought at the hardware store. He also knows his circuit breaker trips whenever he runs the microwave and the toaster at the same time. Arthur decides to shop for new insurance because his rates went up. When he fills out the application, he checks excellent for the condition of the roof. When the agent asks about the electrical system, Arthur says, "Oh, it works fine. Never had an issue." Arthur is practicing adverse selection. He knows he has a higher risk of lost fire from the wiring, water damage from the roof, but he is presenting himself as a low-risk client to get a standard rate. He secures a policy. He feels like he won. He beat the system. He kept his privacy and got a low rate. Now let's look at Brenda. Brenda approaches her financial life through the SafeSimpleSound framework. She understands that her home is a significant asset in her financial constitution. She knows her roof is old. Before she even speaks to an agent, she hires a roofing inspector to give her a report. The report says the roof has about 3 years of life left, provided she seals some flashing. She pays for the professional sealing. She also calls an electrician. She asks, "Is this panel safe?" The electrician tells her it's outdated but functional, though upgrading it would significantly reduce fire risk. Brenda decides to schedule the upgrade for next month, but for now, she installs smart smoke detectors in every room that link to her phone. When Brenda applies for insurance, she acts as a risk architect. She provides the inspection report for the roof. She shows the contract for the electrical upgrade. She tells the agent, "I am willing to take a $2,500 deductible instead of $500 because I want to insure against catastrophe, not maintenance." The outcome: 6 months later, a massive storm hits Stability Springs. Arthur's roof fails completely. Water pours into his master bedroom, ruining furniture and drywall. He files a claim. The claims adjuster comes out and sees the old DIY patch job. He sees the rot that has been there for years. The investigation reveals that the condition of the roof was misrepresented. The insurer denies the claim based on material misrepresentation and lack of maintenance. Arthur is left with a soaked house, no coverage, and a black mark on his insurance record that will make it nearly impossible to get affordable coverage in the future. His lack of soundness led to a total failure of the plan. Brenda's roof takes a hit too. She loses some shingles. Because she was transparent about the age of the roof, her policy has a specific clause about actual cash value for the roof surface. She doesn't get a brand new roof for free, but the water damage to the interior, the result of the storm, is covered without question. Because she had upgraded her safety systems and been transparent, her insurer views her as a partner. They process the claim quickly. Brenda pays her deductible, the house is repaired, and her policy is renewed. While this story is fictional, it demonstrates how our constitutional framework operates in the real world. Arthur treated the system as something to be tricked. He engaged in adverse selection. He sought protection for a risk he was already virtually certain would happen, and he hid the truth. In our practice, we've observed that this approach creates a brittle financial plan. It looks solid from the outside, but it shatters under pressure. Brenda treated the system as a relationship. She understood her responsibility. By maintaining her asset and being honest, she aligned her behavior with the pool. From a SafeSimpleSound perspective, Brenda achieved safety because she didn't have to worry about a claim being denied for fraud. She achieved simplicity because she wasn't managing a web of lies or deferred maintenance. And she achieved soundness because her transfer of risk was legally and contractually solid. This example shows patterns we observe when families apply S3 thinking. The risk architect doesn't necessarily pay the absolute lowest dollar amount on day one. Brenda might have paid for inspections and repairs Arthur skipped. But Brenda purchased certainty. Arthur purchased an illusion. Whether you're facing this exact situation with a home or something similar with business liability or even life insurance disclosures, the principle remains the same. Transparency and maintenance are not just good behavior, they are strategic financial maneuvers. This aligns with the constitutional principle of feasibility. It is not feasible to expect an insurance company to pay for a house that burns down due to known bad wiring that was concealed. That isn't insurance. That's a subsidy for negligence, and the system isn't built for that. By stepping into the role of the risk architect, you are telling the underwriter, I am a preferred risk. I manage what I can, and I transfer what I cannot. As we wrap up today's episode, let's synthesize what we've covered, not just today, but across this three-part series on risk transfer. We started with the math, understanding that risks must be measurable and accidental. We moved to the money, ensuring the cost of protection is affordable relative to the catastrophe. And today, we integrated the human element, your role in the system. Your financial constitution isn't just about rights, the right to own property, the right to build wealth. It is also about responsibilities. From our S3 perspective, you have three core responsibilities in this domain. 1, act honestly. Avoid concealment. Transparency is the currency of trust. 2, maintain your assets. Prevent non-accidental loss. Insurance is for accidents, not lack of maintenance. 3, retain small risks. Use deductibles to prove you aren't using insurance for day-to-day expenses. When you do these three things, you unlock the highest level of protection at the fairest price. You solve the adverse selection dilemma. If you are listening to this and wondering, how do I look to an underwriter? Am I inadvertently signaling that I am a bad bet? We have a resource for you. This episode draws from our recent blog post, The Human Element, which you can find at SafeSimpleSound.com. In that post, we have included a tool called the Underwriter's Lens Scorecard. This is a simple 10-point self-assessment. It helps you look in the mirror and see if you're signaling preferred risk or adverse selection. It is a great first step to taking control of your insurance reputation. Furthermore, as this is the conclusion of our series, we want to offer the complete picture. Through our S3 framework development, we've created the Constitutional Risk Architecture Framework. This methodology synthesizes the math, the money, and the human element into a total risk view map. If today's S3 insights resonate with your family's situation and you want to stop managing these risks in isolation, we invite you to explore what constitutional financial planning could look like through our Safe, Simple Sound practice. But whether you choose to engage with our practice or not, you are now equipped with a constitutional capability. You understand that you are not just a policyholder, you are a risk architect. You have the power to shape how the market views you, and in doing so, secure the foundation of your wealth. Thank you for listening to the Safe Simple Sound podcast. Until next time, may your planning be safe, your execution simple, and your future sound.